Good morning and good afternoon, everyone. Welcome to our 2012 Outlook on the U.S. economy and the office and industrial market. I want to thank you for joining us today, and before we get started, I want to introduce my colleagues. To my far right is Hessam Nadji. Hessam is the Managing Director for Marcus&Millichap Research Services. To my immediate right, Bill Hughes, Managing Director for Marcus&Millichap Capital Corporation. Our goal today is to give you an overview of the economy and our opinion, our outlook for where it is headed, along with its impact on the office and industrial sector. And right before we get started, I want to make a couple of housekeeping comments, if I could. The first would be that you have the ability to submit questions anytime. So throughout the presentation, if we make comments that you're interested in hearing a little more depth of commentary on, please submit those questions, and we will be compiling these throughout the presentation today. And the second thing would be, if you run into any technical difficulties, please look at your F5 key as your friend in that case, and that should be able to clear up anything that would go wrong technically during the presentation today. And one thing that I failed to mention, for many of you who are joining us again, today is our first video version of our webcast series, so hopefully along with us you enjoy this new format. Right before we get started, I want to maybe talk a little bit about the strategic considerations for 2012. We have all had the opportunity recently to attend the NAIOP annual conference, the ULI annual conference, not to mention the fact that we're all traveling quite a bit, speaking to our own agents and many of you as we work our way around the country. And the questions that you see in front of you today are really, I would say, the most pressing as we stand today heading into the new year. So what are they? Economic conditions. Will they continue to support a recovery? The capital markets. Will they continue to improve? Will we have debt solutions that expand, or will they contract? What about the secondary markets? We really didn't see during 2011, have not seen during 2011, a genuine recovery beyond the primary markets, not really in the secondaries and certainly not in the tertiaries. So we'll try and address that a little bit as we go through. How about distressed assets? Will this be a year of growth in distressed, or will that market continue to contract, or will it contract rather, at least in terms of overall delinquencies? Finally, cap rate compression. We're in that conversation quite a bit. Given the interest rate environment, will cap rates continue to compress, or will they extend to additional markets beyond the primaries where we have seen very rapid cap rate compression? So again, it's our hope to cover these questions during the course of our presentation, but certainly as we get into questions and answers after, we'll be happy to get into that a little further. So right now I want to pass the baton to Hessam, if you could take us through the U.S. economic outlook.
Thanks, Al. Good morning and good afternoon, everyone. It's a pleasure to be part of this program. My job today is to talk about where we are economically and what the conditions may look like in 2012, and talk about how that might affect demand and conditions for office and industrial properties. To start with, let me address the big picture concerns and headwinds that we continue to face. Of course, the U.S. is in a very hesitant recovery. We have the two major concerns one coming from the European debt concerns, which are slowly beginning to at least get reduced as a threat because of the solutions that they have been proposed recently. We're cautiously optimistic that if some of these more systemic solutions to the European debt problems actually work out and are implemented, at least that portion of the uncertainty in the marketplace can start to fade a bit. And the other, of course, is the political logjam in the U.S. That has kept a lot of companies from aggressively expanding. There's concerns about taxation. There's concerns about additional stimuli and really how we balance the short-term need for additional government assistance, perhaps, versus the long-term need to balance our fiscal conditions. So we continue to struggle with these, but while these concerns have dominated the headlines, we see improved economic numbers, and the economy shows much stronger footing, and those should not be underestimated. So what I'm going to walk you through is some of those more positive readings on the economy and really try to talk about how they relate to where we're going in 2012. It's obvious that we're in a transition. What you're seeing on your screen now is the GDP numbers for the U.S. having come off the recession with a pretty good level of momentum, thanks to a lot of government initiatives, and then losing steam because of the concerns we talked about earlier. With the concerns that the economy is going back into recession over the past 3 or 4 months, we were looking at fourth quarter 2011 with a lot of caution. The good news is that the economy so far has shown to be more resilient than anybody thought. In fact, most of the forecasters that were predicting a recession have been proven wrong. Our position was that we're going to enter into a stagnation period, but the chances of a recession were still quite low. So far, that's proved to be correct. And by 2012, we begin to see some evidence of release of some pent-up demand and a continuation of certainly below potential and below trend growth rates, but nevertheless positive growth rates. So with this stagnation, the most important reading for us in the office and industrial sectors are, of course, job growth and the makeup and composition of employment. What you see on this graph is a little bit of good news in that the last 2-3 months reading have been positive. Private sector job growth has been above 100,000 a month, far short of any exciting numbers that would give us a convincing recovery, but nevertheless positive. Government continues to lose jobs, especially the local and state government readings continue to be negative. But also we've moved away from a heavy reliance on temporary jobs into more permanent jobs, as you can see on the left side of your graph. So it's a mixed sort of bag of good news, bad news, in that we're not losing jobs. The last 2-3 months, revisions upward have been very encouraging. And there is evidence that companies did not panic when the U.S. debt was downgraded back in August. And that's when all the concerns were being increased regarding another recession. And the positive but disappointing job numbers tell us that we are averting recession and probably will continue to do so. The other very important reading on the economy, of course, is the consumer. Retail sales in the U.S. are up over 6% on a year-over-year basis, excluding auto and gas, and that certainly is a very respectable trend in retail sales because they comprise over 70% of economic activity in the U.S. The trend line for retail sales was incredibly unprecedented during the recession, and the fears that the consumer really was going to prevent a recovery from happening have not materialized. In fact, retail sales in the U.S. are now 6% above where they were pre-recession in 2007. So this is further evidence that the economy is on solid footing, but it's just not going anywhere very quickly. The other very important part of analyzing what's happening with the economy as it relates to office and industrial space is the composition of jobs. The good news on this graph is the 1.8 million private sector jobs that have been created over the past 12 months were very broad-based. We added 562,000 jobs in professional and business services. We added 427,000 jobs in education and healthcare. Both of those speak to office space demand, medical office space demand. Trade, transportation added over 300,000 jobs, and even manufacturing added over 200,000 jobs. So this broad-based nature of the recovery in jobs is very encouraging. It's going to take time before all this job growth translates to space for demand, and I'll talk about that in a moment. Unlike the worst-case scenario forecasts, we're seeing a very broad-based recovery take form on the private sector side. The public sector is where we're losing large number of jobs, and unfortunately, that is expected to continue in 2012. So here's the effect of what we've talked about so far on the economy as it relates to office space demand. You can see that net absorption has been positive for 4 quarters. That is encouraging. What is discouraging is that we're averaging numbers that are very, very weak and far short of really creating a broad recovery in vacancies. So it's a very gradual trend mirroring the gradual improvement in jobs. And for 2012, we expect this pattern to continue, maybe pick up pace a little bit, but certainly not to a level where we can call 2012 the big turning point in the momentum in the recovery. I think we have to work our way through the election process. I think there has to be some additional confidence built by companies. to enter an expansion mode, and that probably will not materialize until 2013. On the industrial side, the pattern is the same, although the absorption numbers for industrial have been stronger, 25 million square feet per quarter, and they've been positive for 6 quarters. Once again, that is short of a driver of an exciting recovery, but nevertheless very tightly correlated to the economic recovery and GDP numbers that we talked about earlier in the presentation. So net, we take a look at 2012, where we've come from since the recession ended, and if you compare this recovery to some other key recoveries that I'm presenting here on this graph, you can see the worst job loss period that we had, of course, in modern history, but a lack of a V-shape or a big release of pent-up demand type of recovery. In other words, we're going from big job losses to just regaining long-term averages, which are depicted on the dotted line, adding 1.7 million jobs this year, a net, and 2.2 million jobs next year. And unlike 1973-75, where we had, for the time, large job losses followed up by way above average job growth, and 81-82 with a similar pattern, this time around, because of all the headwinds we talked about at the beginning of the conversation, our expectation is for a positive yet below trend job creation in 2012. So when we look at the dynamics for the office market, a couple of things come to mind that are very important for 2012 planning. First and foremost, the nature of the recovery shows that large companies have a bigger advantage than small to mid-sized companies. Big multinationals, they have a great balance sheet. They're the ones that are basically hoarding all the cash that you hear about, and their financial structure has actually strengthened since the bottom of the recession. So those companies that are taking advantage of reduced Class A rents, and therefore Class A absorption is dominating the scene, and you're seeing those vacancies come down. We expect to see that pick up momentum even further in 2012. Mid to smaller size companies are still struggling, especially the micro companies with less than 10 employees are still having a hard time accessing capital, and they're still having a hard time gaining enough confidence to get into an expansion and hiring mode. Just since July, the job trends for small companies turned positive for the first time since the recession. So it took a much longer period of time for small companies to start to add jobs, whereas the large companies with 250 employees or more have by far dominated the job creation so far. So that translates to a big divergence in Class A versus Class B, C demand, and that's why we're seeing some of those patterns show up in the numbers. For the industrial market, it's really the same story with a little bit of a different twist in that, like the office sector, the great news is that we have very little speculative construction underway, and the pullback in construction has been unprecedented. The office market went into the downturn without an overbuilding problem. The industrial market, as you can see in this graph, had somewhat of an overbuilding problem, but that has been corrected. And given the steady, although disappointing pace of economic growth, we expect the same pattern to continue for the industrial marketplace, with vacancies continuing to edge down in 2012. In terms of metro trends, a lot of you consistently ask us for different rankings and different ways of looking at metros, and that's not a surprise, because at a time when the macro recovery is relatively muted and we're not in a rising tide helping all boats, metro selection becomes very, very important. So the latest reading on the markets are interesting, with New York, D.C., San Francisco, L.A., Portland, Boston, Houston, and Philadelphia topping the lowest vacancy markets, with some of those actually showing further declines in vacancy over the past 12 months, New York being one of them, Seattle being another one, that showed continued drop in vacancy. That has to do with either absolute lack of construction prior to the downturn or a more favorable job picture. Taking a look at the other side of this ledger, the markets shown on the right are the highest vacancy markets, and these are affected by a combination of either way too much supply prior to the downturn or serious economic challenges. Detroit and Inland Empire in particular come to mind as markets that have been hit by the economic downturn, and there are plenty of other examples such as Las Vegas, Indianapolis, Jacksonville, where those combination of dynamics affect vacancies in a big way. But some of these markets are beginning to show pretty rapid recovery, particularly the markets in Texas. The office market has a completely different characteristic versus the industrial market when it comes to metro selection. Of course, the distribution hubs and those markets that play a pivotal role in the movement of goods, and to some extent even manufacturing, can have a completely different ranking in the industrial side than they do on the office sector. So here we see markets like the Bay Area, Denver, Los Angeles, Orange County, Milwaukee, St. Louis, and again Houston, as among the lowest in terms of vacancy. And again, Detroit, Atlanta, Las Vegas, Charlotte, and Sacramento showing the opposite in terms of very high vacancy rates. But if you look at some of these recovery patterns, it's very interesting to see the divergence that are developing among markets. And for those of you that are looking for value investing, some of these recovery plays, particularly Texas, Florida, may be markets that now deserve looking at. And with that, I will turn the presentation back over to Al Pontius. Al?
Great. Thanks, Hessam. Very good comments, and obviously we'll have some questions at the end, I'm sure. Right before we go to Bill, though, I'd like to ask you a question if I could.
Sure.
Your outlook has been pretty consistent from the standpoint of being, I would say, relatively cautious, but bullish. I would say generally bullish. Certainly a lot less negative than the commentary that I've heard recently at some of these conferences I referenced a little bit earlier. And I don't want to take you negative, but
sure.
What is the one concern that's always kind of in the back of your mind? What's the event or the direction that you are hoping we can avoid?
Well, Al, great question. I get that question everywhere I go practically. But remember, our optimism was built around the fact that the economy was on a much better footing going into this last round of concerns, whether it was Europe or the political logjam. And the headlines overlooked that, whether it was retail sales, corporate profits, which have been higher since the peak in 2006 for quite some time, or even the consumer really holding together, gave us the confidence that things aren't nearly as bad as the headlines suggest. That doesn't mean we don't have serious headwinds. The U.S. housing market is still a big problem. And in terms of what went right, companies didn't panic. And therefore, we didn't see big layoffs. We didn't see the economy turning negative. And if anything, our expectation that we're in kind of a stagnation, low growth rates, but still positive, so far has turned out to be correct. My concern is some event or unexpected problem, could be Europe, could be with the banking system, that creates that panic and makes companies so cautious that instead of hiring a few people, they go into layoff mode. And I don't see that emerging. There's certainly no evidence in the fundamental data that we're analyzing that suggests that may occur, but it's that unknown that makes me worried.
All right, great. Thank you. Again, we'll be back with some more questions. Sure. But, Bill, why don't I turn it over to you, and if you could take us through the capital markets a little bit, please.
Thanks, Al. I don't think it comes at any surprise that interest rates have been a real driver to the commercial real estate market. Certainly, it's enticed investors back into the playing field where they may have been sitting on the sidelines. Cash flows have been improved substantially. Cash and cash returns are much better than they were than 6 or maybe even 12 months ago as a result of these historically low rates. And it's helped values. I mean, certainly these low rates are helping to buoy values and in some instances create a value line that is better than it would have been otherwise. Lenders from the standpoint of where they are today, it's pretty equal to what they've been over the last 6 months. Clearly, it's a bit of a tale of two cities, however, where you've got the best of class to B quality assets in major markets, say gateway and NFL cities. Those are generally easily financed. And then you have, the very spotty market in smaller properties that we have to rely on smaller lenders. In tertiary markets, it becomes very problematic. Underwriting from a standpoint of a lender really focused and continuing to focus on quality and durability of income streams, stable occupancy during the term of the loan, and certainly looking carefully at tenant events and structuring around those tenant events very carefully to the extent that what we're doing is funding reserves in a much greater way than clearly what we've done before. Debt yields 9 to 11%. On an equal basis, 1.3 debt service coverage, producing loans of 60 to 70%, and that's kind of the market, and we've seen that consistently over the next 6 months, and we'll talk about what we will see over the next 6 months in a few minutes. I do want to talk a little bit about the capital stack. The good news today is it is served clearly by a wide variety of life insurance companies, commercial banks, debt funds. CMBS is a whole different topic that we need to talk about. But when we get into the amount of maturing debt, you'll see that we really need all four of those sources of funds to be able to service what we believe are the needs for the next few years. So let's take a look, if we can, at interest rates. We like to compare them against core inflation. I think it's an important relationship there, and it's consistently one. You'll see that the 2% on core has hit its 10-year average. Certainly, the 10-year Treasury is far below its 10-year average and has some room to move. If you look at the far right of this chart, you'll notice that they've intersected, and while the core inflation has gone up, the 10-year has dropped down. We really see that as a fear factor, more related to ongoing choppy economy. Certainly, what's going on in Europe, as Hessam talked to earlier, with the debt crisis there, and investment in our treasuries, which is really still the gold standard as we move forward. So moving to, what are the originators? Who are the people that supply debt? If you look at 2010, 2011, clearly 80% plus of the debt has been provided by CMBS, life insurance companies, and commercial banks. Commercial banks being all types of commercial banks, local, regional, and major commercial banks as primary servicers to the commercial arena. Office and industrial, effectively about the same. Certainly office has done well with life insurance companies, and commercial banks really more in the industrial sector and moving along. I think what we want to do is take a quick look at commercial delinquency rates if we can. I think if you look at the third quarter, depending upon whose service you use, actually in October they've moved up to a 977. That's a 21% increase, although it had fallen off over the previous couple months. In July it was 988. With specific emphasis on office, if we look at, and I know this chart particularly shows through the second quarter of the year, but if you look at October, office today is at 1159. Office is at 885. Industrial is at 1159. If you look at a year ago, office was at 668 and industrial was at 627. So obviously there's been a significant 500 basis point move in industrial, with about a 200 basis point move in office in terms of increased delinquencies. Talking about banks and thrifts, it's actually moved down from the third quarter of 2010 when it was 441 at 393 at the end of October, and certainly we expect that trend to continue in that sector. Life insurance companies, it's almost not worth talking about. Less than 0.5%, bodes well for how they underwrite. They've stuck to their guns in underwriting, and they've been pretty conservative as they move forward. So one of the things that we need to look at here, and I talked a little bit about there, spoke to it just a few seconds ago relative to maturities, we need a full assortment of lenders to be able to deal with the maturities that we're facing over the next 5 years. If you include 2011, $1.77 trillion of debt maturing, which is significant. 2011, let's talk about banks if we can, $204.5 billion. 2012, $213.4 billion. 2013, 2013, $210.4 billion. We are increasing the amount of debt that's maturing over those 3 years, and certainly we need a full assortment of the 4 major food groups, if you will, to be able to service those certainly maturities. The importance of those 4 lenders staying active is really going to show up in this next slide, and I think this is highly critical. Of the 1.77 trillion debt maturities, underwater over that period of time, 1.06%, almost 60% of the current loans within all of the categories are underwater. Now, underwater means that the loan exceeds 100% of value, and that would lead you to think, oh boy, we're going to have a lot of stress coming to the marketplace, a lot of distress in the marketplace. The nice thing is if you look at 2011, if you look at previous years, the marketplace has been able to deal with that on a pretty consistent basis, and we see that as positive. We think that will continue as lenders extend loans, as we recapitalize partnerships, as we have these other sources that come to play, particularly in the CMBS arena and in debt funds. We are going to be able to use the debt funds, obviously, to capitalize at a higher level. We need the CMBS in the marketplace because they will underwrite to a much greater extent. I talk about CMBS because here's the key. 2011 we had about 11 billion in 2010 we had about 11 billion in issuance. This year, forecast 35 to 50 billion. The reality is that we're going to fall far short of that. We'll talk about that as why in a minute. But right now we're at about 27.2 billion. I'm suggesting with what I think is coming to the marketplace over the next next 2 months, effectively something about 32 billion is about all we're going to get to. CMBS spreads is certainly part of that. The 10-year AAA were 179 on July 8th of this year. They soared to 339 on October 7th before retreating to 283 by the end of the month, caused by a lot of the things that Hessam spoke to: European debt crisis, choppy domestic economy, slow unemployment, concerns over domestic debt, and obviously consumer confidence plays well into that, and I think it will continue to play in that as we move forward. Now, the nice thing is, I know last week a issuance, RBS and Wells just went to marketplace. It was pretty well received. We saw spreads come in a bit from certainly those highs, both in the AAAs and BBBs. Investor confidence seemed to come back. Investors are willing to take on more risk, certainly, than they have in the past. If we can move to investor considerations now, outlook for 2012. The debt and equity markets for the first half of 2012 should resemble pretty much with what we're dealing with for the same issues that I just spoke with investor and confidence in the secondary market with CMBS. You've got slow unemployment, you've got a choppy economy, you've got foreign sovereign debt issues, you've got the fact that we've got to deal with our own debt in this country and extensions. Those issues will keep this interest rate environment pretty flat for an elongated period of time. Capital supply should remain healthy, but certainly not for every asset. Life insurance companies this last year did more than what they had anticipated. We think in listening to them, they're going to increase their allocations into 2012. That's positive. Regional local banks have become more active. We would love them to really push their level of investment in 2012. Debt funds certainly have become more active. I was just at a recent event. There were 15 different debt funds represented at that point in time, both in terms of restructuring debt and value-add transactions, providing us a lot more options, finance options in the market. The big issue is where is CMBS going to come in? Is it going to be a $20 billion market? Is it going to be a $40 billion market? We're going to have to see how that plays out, certainly over the last few months. But as I said earlier, this RBS, Wells Fargo issue that's just gone to market, it's at least turned the corner. It looks like we're going in the right direction. So let's look at investor strategy. If you're an investor, you've got a loan maturing, you're a little bit upside down, what do you do? That's always the question. That's probably the number one question. One is, certainly we still see lenders extending, although not as aggressively as they were extending in the past. If their loan is starting to approximate the value of the property, there's going to be more pressure on them to move to marketplace. That means that you're either going to have to recapitalize as an investor, go find a new lender, or they're going to take the property back. They're going to operate it until they can make money on it. This is not going to be a fire sale type of an environment. Refinance. Excuse me. If you're a $1 to $10 million investor, certainly there are lenders out there for you. Smaller local and regional banks are active in the marketplace, generally producing loans of 70%. They are recourse, underwriting commercial transactions, office, industrial at 1.3. You should get a loan somewhere of 5.5% to 6.5% for 7 to 10 year types of financing. If you're 10 to 20 million, the arena opens up a little bit more for you. Life insurance companies certainly participate at that level. Debt funds will participate as those deals get larger, certainly above and approaching 20 million. Life insurance companies and commercial banks. So you have sort of a full assortment of recourse and non-recourse debt available to you. And then above 20 million, certainly you have full option of lenders, you have full option of structuring, and rates are going to be pretty good. You know, we've seen some deals lately, 10-year rates, 4.5%, 4.25%, up to about 5%. CMBS, at 425 spreads, you're at 6%. But all in all, you've got to look at those are historically strong rates. So with that, I'd like to turn the presentation back to Al.
Great. Thanks, Bill. If you can hand me the...
Sorry. Al, before you get started, one question that I thought of for Bill that I thought might be worth taking a moment on. Bill, you showed on one of your slides the inflation pattern moving up to the 10-year average, but the 10-year yield, of course, has come down. What does that tell us in terms of future outlook for inflation and interest rates, especially after some of the fear factors I talked about that might dissipate over the next 12 months? Do you see that as a problem, potentially with a run-up on interest rates?
Well, in a normalized market, clearly it's a problem. That would tend to indicate to me next week interest rates are going to turn around and start to move up fairly rapidly. Inflation is a key component to bond valuation. It's a key component to interest rates, and typically inflation will start to be the precursor to a cause in interest rates. I think you've got some things that have held interest rates down. Certainly the government, Operation Twist, QE2, the government really seems to be hell-bent on keeping long-term rates pretty low. You also have this fear factor in the marketplace that Hessam spoke to, and it is going on. I just think the choppiness in the marketplace. I don't think that the consumer is willing to lay down its guard yet. I don't think the secondary market is willing to take on much risk yet. So I don't think there's going to be some great pressure on treasuries, even though we're starting to see some core inflation hit the market.
Got it. Great. Thanks, Bill.
Great. Thanks again, Bill.
Thank you.
All right. What I'd like to do now is take us through a little evaluation of the investment landscape, and following that, we'll get into some questions and answers. So let's see if I can advance our slide to the first. Here we take a look at office and industrial transactions on a national basis. This, to me, is a very positive slide, at least from a transactional point of view. What you see is a pretty distinctive rise off of the bottoms of 2009, where we got into incredibly low transaction volumes. What is a little more difficult to see in the graphic is the fact that in 2009, a $10 million transaction became a mega deal. We really saw the fallout in the larger transactions and less of a fallout in the smaller transactions, or that is to say those valued below $10 million. Today, we see expansion in both office and industrial across the pricing spectrum, and actually a little bit higher growth on the larger side. The final comment I'll make here is we're essentially back to a 2003 level. Trend line suggests we'll be approaching 2004 in relatively short order. And that, again, from a transactional point of view, has to be very positive because when it was 2003 and 2004, we all felt very good about the environment, and then we hit some years, 05, 06, 07, that we had never seen anything remotely like that before. And we certainly can have a healthy real estate environment without being at those kinds of transaction levels. And I don't know that we're headed back there anytime soon. But again, from our perspective, from my perspective, in both office and industrial, we feel very good about the trend lines and the opportunity to trade. So who's buying? Let's take a look. The graphic that you have up on your screen now speaks to both the office sector and the industrial sector in terms of who's buying, and they're interesting for maybe different reasons. If you look at the office graphic, you see that the private investor is relatively the same today, relative same position, that is to say, in 2011 as they were in 2007. But then the differences occur. The public activity has increased, pension fund activity has increased modestly, private equity, which was a big player in the game in 2007, minor player in 2011, the return of foreign capital, especially when compared to 2007. So it's interesting to note that the landscape, the buying population, does change dramatically from year to year. So you can't simply look backwards and say, there's our landscape. It really moves around, and for me personally, very interesting to compare what most would suggest as the peak of the market to what we would call a recovering market in terms of transactional velocity. On the industrial side of the ledger, the points may not be so graphic, but for maybe certainly a rebound, as you see in the private equity sector, although even that comes with a bit of a qualifier. That is to say, there are two particularly large transactions that skew those numbers a little bit. So how about pricing and cap rates? We, as Hessam pointed out earlier, we have that question all the time. What's the direction? These are broad market numbers, meaning the scale is at $1 million price point and above. The other point about the scale is that it's all classes of assets and it's across the geographic spectrum. I bring that up because when you look at a cap rate, which according to this graphic is still little over 8%, some of you may wonder, gee, I thought cap rates were lower than that. And they are in primary markets. But this is an across-spectrum rendering the trend line distinctively down from the high point of 09. The caveat that I'd like to make, you see that price recovery on a per square foot basis has been substantial. We're now in both cases about 25% off of peak. The caveat that I would offer is this. The market is much thinner today. What is liquid today is different from what was liquid in 2007. So whereas 2007, the majority of real estate was liquid, in 2011, it's a bit of a tale of two cities, as the cliche continues to be mentioned time and time again. So I think you do have a little bit of a false statement there in terms of the depth of the recovery against a 2007 peak. But nonetheless, we are recovering, and I might add, there are certainly more distressed transactions as a part of our sales population today than there would have been in 07. So that is a bit of a counterbalance. Taking a look at cap rate trends, this is a slide that we've referenced many times in our presentations in the past, and I won't belabor the point, but to say the gap has opened up again, significant gap, larger than historical in terms of the 10-year Treasury and where we are in cap rates. So what does that really suggest? Many would suggest, well, maybe more cap rate compression. The primary markets have moved so rapidly that I would say there's limited to no cap rate compression left in the primary markets. Furthermore, I don't know that anybody looks at the bond yields today as being permanent. We're living still under somewhat historical times. Certainly, I think the secondary markets have room to make some moves, and we'll come back to that type of conversation a little bit later. So breaking down the cap rates, both office and industrial, and trying to look at them not from a class standpoint this time, but really from a geographic standpoint. Primary markets, secondary markets, and tertiary markets. And really what's occurred, well, let me back up. I would say that this movement is a little bit different than we expected, or certainly than I expected coming into 2011. We had already seen the recovery in the primary markets, and that line remains steeper than in the case of secondary and tertiary. But frankly, I had some expectation that we'd see the secondaries and even the tertiaries start to open up a little, and that really didn't play out. And in fact, that closed down even further about a month or two ago as concerns over the world economy and certainly the U.S. economy were amplified once again. So really where we are today, we have significant gap. If you take a look at the graph and work your way back into a 2007, 2008, you see such a tight gap between primary and tertiary markets. And you now see reflected in the market sentiment, you see significant differential in how investors look at the various geographic divisions of primary, secondary, and tertiary. And today as we sit, I still say there is recovery occurring and will be recovery occurring in the secondary markets. But today the tertiary markets are very, very challenged for liquidity, primarily because the exit level in a tertiary transaction is such that most owners are prepared to continue to be owners rather than sellers at that point in time. So the tertiary markets have certainly slowed down. Taking a look at office, you've already seen some of these statistics before. At least on the left side of the graph, you see a look at vacancy. And on the right side of the graph, you see markets ranked by activity in terms of dollar volume. And what you see, I think I'm remembering this correctly because the notes are a little far away for me to read right now from what you have on the screen, but I think 7 of the 8 markets that you see on the right side of the screen are ranked towards the top of the left side of the screen, meaning this. The investors are actually showing a very high degree of logic in terms of correlating fundamental strength, fundamental recovery with where they want to invest capital. So you hear this a lot. You hear about the flight to the primary markets. All the money's going there. It's driving the cap rates down. When are people going to quit knocking each other out of the way to compete in the primary markets? But the driver is this. This produces liquidity. It also produces upside on the investment through rental growth. And so you see a lot of correlation in the office market between fundamental strength and where the investment dollars are going. Obviously, like anything, you'll see some exceptions. Those exceptions are most notably in either larger markets that have the benefit of size and therefore a certain level of liquidity associated with that size. But you also have some markets that have a high level of distress and investors being countercyclical, if you will, or chasing distress, looking for the larger return, the amplified return that can come through the rebound. The industrial sector, you see some similarities, but they're also different. The primary difference that I would highlight, if you look at where the transactional volume lies on the right-hand side of the screen, you're really talking about, with Washington, D.C. as the only exception, the Washington, D.C. metro is the only exception, you're talking about the 5 largest distribution centers of the United States. And consequently, the investment dollars, by virtue of that size and by virtue of looking to play the rebound in distribution, the rebound in the economy, you see the larger markets attracting most of the capital. Again, there are still some markets with fundamental recovery driving investment, no doubt about that, but it's a little different landscape of what's making the move in industrial when you compare it to office. Let's come back to office for just a couple of slides before we get into some Q&A. This is something that our research department put together that really catches my interest because it shows differentiation, intense differentiation that exists today. If you look at about a 2009 area, now part of this, and then of course if you go back into 05 and 06, you see a tightness or a narrow gap between differentiating your Class A asset from your B, and of course we've differentiated further to take a look at top 10 markets. But here's what we see today. What we see today is this is opened up. Differentiation is much higher. If you are in a top 10 market, top 10 defined as size of metro, volume of trade, if you're in a top 10 market, the behavioral similarities are just that. The A is moving well, but so is B and C. As you remove yourself from those markets, you see the flattening and the removal, if you will, from the Class B and C asset. Does not mean that they don't trade. We trade a significant volume of the B and C grade asset, but the characteristics of the trade are very different. The investor profile is very different. And the challenges, candidly, of bringing the transaction together and keeping it together are also different. And I think this graphic makes it clear how investors are looking at that shift. And this will take that to yet another level. If you take a look at year-to-date sales through the third quarter, of 2007, compare that to the same period of 10, compare that to the same period this year, and you see some marked differences. Back to 2007, essentially what I would say on a 50-50 split, you see very limited differentiation between being in the primary markets or the premier markets and being outside of those markets. You saw that that distinction change in 2010, and you see that distinction being exaggerated still further today. This is what I mean by the markets becoming more narrow. Investors are very discerning, and this is where the haves and have-nots come in. This graph, what I would have said and did say literally 3 weeks ago, was that by the end of this year, this figure would turn to 70%. That's how narrow the markets have gotten in terms of preference for the premier markets. The caveat that I now throw on my own comment is that with Blackstone's pending acquisition of the Duke suburban portfolio, that will actually change these numbers a little bit. So if anything, it may actually start to move the other way. But I would argue that is a skewed event, that is such a large and market-moving event that it has a chance to change these numbers by itself. But for that, I would say that this trend was actually going to expand a little bit further. So that is my final prepared comment today, and I want to thank you for the opportunity to work through that. And now we'll have an opportunity to speak with you a little more personally and answer the questions that you've submitted during the course of the presentation.
Great. Al, thank you very much. Thank you for all those that have submitted questions. We received many of them. We'll do our best to address as many as possible on the time remaining, and we'll address the remaining questions via email. So, Al, let me start with you with a common question that's come up many times from the audience today, and that is, if the migration to Class B, B minus, and value add has not occurred as anticipated, does the Blackstone acquisition signal an opening of the floodgates, per se, to higher yield, a little bit more risky types of investor appetite going into 2012?
Well, again, Hessam, and as I mentioned, and I appreciate the question from the audience, as I mentioned a little earlier, I actually thought that trend would occur coming into 11. Right. And then we hit some economic bumps in the road that I think renewed some concerns, some fear, and therefore had everybody chase a tighter definition of core.
Right.
I am positive that the Blackstone trade will have an impact. Blackstone is a highly respected investment entity in the United States and in the world. And when you see a trade occur in that volume, when you see a bet being made that substantially, I don't think there's any doubt that, viewed as a market leader, that this will open up other interest in taking a look at secondary markets. So I'm positive it will be a market changer.
One of the investors also asked a follow-on question to the same, and that is, what about tertiary markets? Should they be viewed as a true opportunity investment, or is it too soon?
Well, it's clearly too soon, in my assessment. We've just seen such poor liquidity in the tertiary market. So let me say this. If you can acquire an asset that you have a long-term point of view on and are not concerned about a short-term exit, and to me, today, short-term is 2 to 5 years. So if I am not concerned about a short-term exit, then I think that there are plenty of tertiary markets where the balance between supply and demand is good, threat of new construction is nil. So yes, there could be some good plays, but if liquidity is your concern, it's too soon.
Great. Thanks, Al. Bill, the next question is addressed to you. A lot of our audience members want to know about the outlook for commercial bank lending and recourse versus non-recourse loans as we go into 2012 and maybe even 2013.
Well, I think what you've got is a propensity for recourse lending in the marketplace. Banks by themselves tend to be recourse lenders. They tend to be shorter-term lenders, 5 to 7 year type of debt lenders. most of the non-recourse product is done by life insurance companies unless you get to really low loan-to-value kind of transactions. So we think it's good. We think that the banks have certainly healed their portfolios. We saw in the last 6 months the emergence of major money center banks come back into the marketplace in a pretty healthy way. We think that's going to continue as they continue to make profits and do well. And I think that that's something that we need to be aware of. I think if you compare 2011 to 2012, other than the big question of CMBS, we are going to have more capital. Do I see a significant change between non-recourse and recourse lending? I think it'll be the same, but whenever there's a question, whenever there's a concern, lenders got to reach out to recourse financing and try to get there, particularly if there's a story to be told with a deal and he's relying upon the borrower's financial statement to make his decision on moving forward.
Sure. That makes sense. Thanks, Bill. The next question is actually addressed to me. And this audience member asked a question, and if we've added nearly 600,000 professional and business service jobs and even manufacturing jobs, why aren't we seeing stronger absorption, in particular for the office market? And Al, I'd like you to weigh in on this as well. And the reason for that is because of excess space. A lot of companies are sitting on extra space that they may have attempted to sublease. It didn't sublease. They took it back. Or maybe they didn't even attempt to sublease it. But in this early stage of a recovery, we're still burning through excess space, especially in this environment of high uncertainty and fear. So it's not surprising to see the job numbers in that sector actually be quite healthy, but not necessarily translating into immediate net absorption of space. There's certainly leasing activity, but a lot of companies are now looking to downsize, are looking for more efficiency. So that's more of a macro trend of space utilization reduction that we're also seeing in the office market. But by 2012, certainly middle of 2012, end of 2012, we're going to see a lot of this excess space go away. And more of the leasing activity should turn into a stronger net absorption. Al, do you have any comments on that?
Well, you hit the nail on the head. I mean, there is plenty of space out there that today is underutilized or wouldn't be utilized at all but for a lease in existence. So outside of the high-tech markets right now, it's very difficult to see any kind of robust absorption. And I think if you went through the markets that we're seeing absorption, that's exactly what we would see. But again, you're correct that the excess space is something that we have to burn through. And the good news is we are burning through it. The new supply, which you referenced on a slide earlier, has been very, very thin, historically way below past periods of time. So I think we're in pretty good shape going forward in that way.
One more question coming in from the audience that has to do with distress. We received a number of inquiries about your outlook on distress assets. Really addressing this question goes to the two of you. Do you see anything on the horizon that would have a marked change in the strategy of lenders not to fire sale assets and bring more inventory to market in 2012 or 13? Bill, you talked about the maturities. Certainly they're large in volume, but we've seen a strategy play out of avoiding fire sales on quality assets. And this audience member is asking the question, could something change that in 12, 13 that would bring more properties to market under the distressed status? Bill, you want to start with that?
Yeah, I think the reality here is that you've got a marketplace that has learned to deal with stress. I think the only thing that would be a big game changer in the arena of success is if we saw the marketplace just absolutely plummet. If we hit a double dip, lenders thought that they weren't going to be able to bail themselves out for a long period of time. They need to create cash to be able to keep their business enterprises going. Then you might see a wholesale dumping of this real estate into the marketplace. What we've seen, however, is that lenders have learned from the RTC days. They're quite patient. They know that the marketplace is coming back. It seems to be healing, although certainly, as I've said and everyone else has said, it's pretty choppy. And I think that they'll continue to do that. We are seeing the liquidation of some of these assets through note sales. The amazing part of the note sales, they haven't been perhaps as deep discount as many of us thought they would be going into the marketplace, and they're going to funds that are holding them, fixing the problem in many instances, and then selling them back out of the marketplace at far less discounts than what we might have originally thought. Al,
any comment on that?
I don't want to add too deeply to it, but I will say that we have featured a slide that we did not feature today, one that shows the growth of volume of distressed asset sales. And it has been a pretty symmetrical stair step up all the way through this year. I expect that will continue. But I expect the market will still feel very much like it has felt. In other words, a lot of people look for that high-quality asset at a deep discount.
Right.
We have not seen that, and I do not expect that we're going to see that. That's where the workouts are taking place. But a lot of the debt that will be maturing, that has already matured, is placed, frankly, in peripheral grade assets, tertiary markets, secondary markets, B-grade assets.
Construction loans.
Right. And so what will happen if there's a lack of confidence that these properties are actually going to be turned around and perform, the better execution to the lender may be to punt and go to market. So I expect we'll see a continued increase in distressed asset sales.
Which leads me to the next audience question, and that is related to the residential market and how ongoing problems in housing are holding back the economy and what the differences are between the cycle in commercial real estate investing versus the housing market. And one important thing that comes to mind is the fact that on the commercial side, only about anywhere between 10 to 12% of sales have been foreclosed distressed dispositions, whereas in the for sale housing market, that's been averaging 25 to 30% over the past 2-3 years for obvious reasons. And that has allowed the commercial market, from the standpoint of distressed sales and price recovery, to move far ahead of the residential market. But there's no doubt that the consumer is highly affected by the housing market, and we're not anticipating a meaningful price and sustainable recovery in 2012 for the housing market, but we are getting closer to bottom. We have at least 2 or 3 major waves of foreclosures to work through, and that is one of the reasons why our job forecast and overall economic growth forecast for 2012 is still somewhat muted, because the housing market has a tremendous effect psychologically and directly on consumer spending, and we don't anticipate a meaningful and sustainable recovery in the for sale housing market until 2013. And therefore, it's not going to contribute to economic expansion. But one of the interesting points that comes up now related to the industrial market is that if you look at exports, U.S. exports, we always talk about the deficit, but if you look at the export component of our economy, it's growing at 6 or 7% a year, and it's contributing 13% to our total economic output. For sale housing only contributes about 2%. So that's another one of those examples of the headlines not picking up on the positive and really focusing on the negative. But it'll be some time before the housing market is a contributor to economic activity. Next question goes to you, Al, and I think in the interest of time, we'll make that one our last one. And then it has to do with this audience member's question as to the pause in the marketplace. In August, when we saw the U.S. debt downgrade and increased fears about what was happening in Europe, did you see a pause in transaction activity? If so, what type of properties were put on hold? And are we past that, or are we still in a pause, if there was indeed a pause?
There certainly was a degree of pause of properties entering the market, because measured by new listing activity, we went through a couple of months where our year-over-year listings were actually down. So there was clearly a pause in terms of owners feeling that now is the time that I want to enter the market. But despite that, our contract activity continued to escalate, and our closing activity continued to escalate. So that might sound like a little bit of a disconnect, but I think that the market develops its early thoughts of what is actually going to happen, and then when the event takes place, that was the event that everybody was forecasting anyway. So I think really what has impacted the market more than that, just in the last month and a half alone, is frankly the concerns about Europe, extended concerns about the housing market that you continue to talk about, and just, if you will, renewed doubts about are we really going? Is this recovery? Are absorption trends going to continue? So I think it's way more renewed doubts that have re-entered the market over the past 60 days, much more so than going back to August.
Do you anticipate now that we're getting some positive readings on the economy and the worst case is certainly not happening? It looks like we're still in a modest growth phase, not another recession. Do you think that's going to bear some positive influence on transaction activity going forward?
No doubt about it. No doubt. It's interesting. This has kind of been the season we talked about earlier, this kind of conference season, and we have the opportunity to be invited to speak in front of some audiences on occasion. And it's almost as if my comments have changed 2 or 3 times in a 3-week period, because that's just how volatile the conditions are. So I think what was looking very negative only a month ago or so, I won't say nobody's concerned anymore, because that's certainly an extreme that I won't comment on. But it's just, again, it's changed again, and I'll go back to it again. I'm not looking at it as the bellwether, so to speak. I'm not looking at it as the anchor. But Blackstone's decision to move on the Duke portfolio has a lot of influence on how people look at and perceive real estate investment as we head into 2012.
Great. Al, with that, I'll turn it over to you for closing comments.
Great. Thank you. And one last time, I want to thank you for spending time with us today, taking time out of your schedule. Hopefully what we've accomplished is we've given you some commentary that you can actually use as you formulate your own decisions about how you want to participate in the real estate market and how you want to manage your investments as you look at 2012 and beyond. As Hessam pointed out earlier, if there are questions that we did not get to today, we will make a point to get back to all of you. So one last time, thank you. Have a good day, everyone.